In the next chapter, we look at interest rate risk, which is one specific area of financial risk. Firstly, we'll briefly define what the risks are from changes in interest rates to organisations, and then look at some of the controls that they can apply. There are a number of practices or internal procedures that organisations can use to manage this risk, and we'll cover those briefly. We'll then look at some of the external controls, some of the controls that can be operated with the help of outside parties. Now, there are 4 techniques that are covered in the syllabus. The most important of these are interest rate swaps. Swaps are the ones that are examinable numerically. Okay, so you may be set numerical questions on swaps. We have seen that in the past. You'll need to work through the calculations. The other tools that we'll cover are not examinable numerically, but you do need to be aware in general terms of how they operate. There are interest rate futures and interest rate options, so we're going to apply what we learnt in the previous chapter about these tools in general, specifically to interest rates. And we'll also introduce the idea of the forward rate agreement, or FRA, which allows you to fix the interest rate you're going to pay for a future borrowing. So let's examine in a bit of detail what we mean by this term interest rate risk. Or remember our working definition of risk: what could go wrong? Well, what could go wrong resulting from changes in interest rates? There's a number of things. Firstly, there may be issues relating to this mix that a company has adopted of fixed and floating rate debt. Now clearly, if interest rates go up and you have fixed rate debt, then that's good. You're paying a lower interest rate than the market level. On the other hand, if interest rates go down and you have fixed rate debt, that's a bad thing. You're paying for debt that is more expensive than it needs to be. So either way, whether you go for fixed or floating rate debt, there is a risk. Secondly, you may have risks connected with the term of the loan. Loans are normally for a fixed period of time, a fixed number of years, and at the end of that period you need to refinance them. So if you have a 5-year loan, then after 5 years you'll need to either repay it or refinance it. Now, one issue you may discover, and that has been quite common in recent years, is that there simply is no debt available, that no one is prepared to refinance the debt. So maybe you have to repay the loan before you really want to, or maybe you have to pay higher interest. And thirdly, there may be risks resulting in general terms from increases in interest rates. When interest rates go up, profits and cash flow go down for organisations that have borrowings. That's going to have a knock-on impact throughout the economy. It may have an impact on your customers, on your suppliers, and anyone you deal with. Now, there are a number of controls that organisations can operate to reduce these risks without involving outside parties. First of these that we're going to deal with is smoothing, and this means that you keep a balance of fixed and floating rate debt. So just to illustrate this, let's say you have £20 million debt in the organisation, and you're wondering whether to have this as fixed rate debt or floating rate debt. Now, either way, as we've seen, there is a risk. But what you might choose to do is split it and have, let's say, 10 million fixed and 10 million floating. That way, if interest rates go up, you'll pay more on the floating rate debt, but you won't pay any more on the fixed rate debt. If interest rates go down, then you'll pay less on the floating rate debt and the same on the fixed rate debt. So you'll still get some of the benefit. So this way, you will contain the risks. Second approach you can take is matching the type of loan with the asset you're acquiring. And let's say that you're going to buy some sort of asset and you think it's going to generate a return that is variable, that is going to be linked in some way to floating interest rates. In that case, the financing for that asset should be floating rate debt. If you think the return is going to be more fixed, then it might make more sense to finance it with fixed rate debt. And finally, pooling means that if you're a group of companies, you can actually bring together your cash balances, and there are some benefits to doing this. So let's say you're a company with a number of subsidiaries, and company A, let's say, has £10 million credit balance, company B has an overdraft of £5 million, and company C has an overdraft of £1 million. Now, if you ran those companies with their cash balances separately, company A would receive interest, and companies B and C would be paying interest. And generally, the interest paid on overdraft is higher than anything you'd get for a cash balance. But with pooling, you will actually bring those balances together, and the bank will treat you as if you had just the one credit balance of £4 million. That way, you'll receive interest on the £4 million, and you won't pay any overdraft interest at all. So again, this helps to manage risks associated with interest rates. Now, there are also 4 tools that do involve external parties that organisations can use to manage interest rate risk. Interest rate swaps we'll look at in a bit more detail because they are examinable numerically. You need to know the calculations behind them. We will also look briefly at forward rate agreements, interest rate futures and interest rate options, but you only need to be aware of how these can work. So let's have a look at what an interest rate swap is. It's probably easiest to explain the way it would work. Let's say you have 2 companies. Let's say you have company X, company Y. And company X takes out fixed rate borrowing, and company Y takes out floating rate borrowing. Now, for reasons that we'll look at shortly, it may be advantageous to them to swap repayments so that company X actually pays floating rate interest and pays effectively company Y's interest, and company Y pays fixed rate of interest and effectively pays company X's interest. So that's the concept. They'll end up paying each other's interest. Now, why might they do that? Well, there's 2 reasons. Firstly, company X might have taken out a fixed rate loan, let's say 2 years ago, but now wants to have a floating rate loan. Let's say that company X thinks that interest rates are likely to fall, and therefore they want to change their debt from fixed to floating rate. Now, one way of doing this is to go back to their bank and asking their bank for a floating rate loan. And the bank will do that, but it will probably be expensive and could be time consuming. There's going to be documentation, paperwork and fees and so forth. It may well be quicker and easier to simply do a swap, to find another company that wants to swap with them, or there are organised markets where you can locate counterparties for these deals. So that's one reason why you might do a swap. You might just want to switch your type of borrowing quickly and easily. And secondly, for reasons that we'll see when we come onto the numbers, it may actually work out cheaper. It may be possible to exploit some differences in pricing so that both company X and company Y end up paying less interest. Now just hold that thought for the moment, and it'll become clearer when we look at the numbers how that can happen. Now, questions on swaps are quite likely to ask you about the advantages and disadvantages of this particular tool, as well as doing calculations and explanations. So it's important to be aware of these. What's good about swaps? Well, as we've seen, they are a pretty cheap and easy way of switching the type of interest you're paying, or indeed the type of interest you're receiving. Because it may be that you are, for example, receiving a fixed rate of interest, you want to receive a floating rate of interest. This is a quick and easy way of doing it. They're very flexible. They can be transactions of perhaps up to very large amounts, and they can be reversed if you want to. As we've already mentioned, it may be cheaper to do so, and they last quite a long period of time. They last longer than the other tools we're going to look at, forward rate agreements or interest rate guarantees, which tend to be quite short term. Some of the downsides, well, you may want to take advice. These can be quite complex contracts, so you need to know what you're doing if we're entering into one of these. There is counterparty risk. If the other party involved in your swap goes bust, we imagine our company X and company Y, if company Y goes bust, then the swap will unravel. So this will all go away, and company X is just going to be left with its fixed rate of interest, which it didn't really want. And finally, there is no organized exchange in the way that there is an organized exchange for example, futures. So there's no exchange, there is no regulation, and anyone who deals with the swaps market is basically on their own. Let's work through a numerical example that will show you how swaps can work, and also set up a pro forma that you may find useful in dealing with exam questions on swaps. Take a moment just to read through the lecture example, and then press play when you're ready to continue. So let's work this example through using a pro forma that will help us answering many swaps questions that you're likely to get in the exam. We need to set up a column for each of our companies. So we've got company A, company B, and for reasons that will become clear, it will also be useful to have a total column. Now it helps if we start off by focusing on what it is that company A and company B actually want. And we're told in the scenario company A wants ultimately a floating rate loan. So company A wants floating. Company B is looking for a fixed rate loan, and that's what makes a swap possible, that they're each looking for a different type of borrowing. Now one way for each of them to get what they want is for them simply to go to their bank and get it. So could borrow with no swap for company A. If they go to their bank and they get a variable rate loan, they will pay LIBOR plus 1%. So they could borrow, if they want to, at LIBOR plus 1%. Company B, if it goes to its bank and simply gets a fixed rate loan, will pay 7%. Now that means if they both go to their banks and simply get the type of borrowing they're looking for, the total that they will be paying collectively is LIBOR plus 8%. So that's be the total borrowing on their two loans. But what happens if we do a swap? So could borrow with a swap. Well, that would involve each of them going and getting the type of borrowing that they don't want. So A goes and gets a fixed rate loan, and they can borrow at a fixed rate, if they want to, of 8%. B can go and borrow at a floating rate of LIBOR minus 1%. So what that means is that if each of them goes and gets the type of borrowing they don't want, and then they do a swap, and we'll come on to how the mechanics of the swap will work in a second, but if they both go and do the type of borrowing they don't want, they will actually pay collectively LIBOR plus 7%. In other words, it will work out cheaper for them to borrow what they don't want and then do a swap. Now there is a fee involved. We're told that the bank will charge a fee of 0.2% for each of the companies, and sometimes banks do this. They get involved in locating counterparties and arranging swaps, and they charge a fee for that. So there is going to be a fee of 0.2% for each company. That is a total of 0.4%. And even so, the companies will be better off doing the swap, because they're going to benefit by 1%, the difference between the interest rate without the swap and with the swap, and then they're going to pay 0.4% of that in fees. So the potential gain that they stand to make is LIBOR plus 8% minus LIBOR plus 7% minus 0.4%. They will actually be 0.6% better off between them if they do the swap compared to if they don't. Now, we're not told in the lecture example how they're going to split that gain, but if we're not told, then we can assume the gain will be split equally. So if this is split equally, it will amount to 0.3% for each party. What we're now able to do is work out our target outcome. So where do we want to end up with our cash flows? Well, what we want is for each of the parties to pay a rate of interest which is 0.3% better than the interest they would be paying with no swap. So we take this no swap rate and we subtract 0.3%. So where we want to end up is that company A is paying LIBOR plus 0.7%. Yeah, so LIBOR plus 1 minus 0.3 gives us LIBOR plus 0.7%. And company B will be paying 7% minus 0.3%. Company B will be paying 6.7%. So that's where we want to get to. That's our overall target outcome. Now what we need to do is work out the relevant cash flows for the swap. So the first thing that's going to happen is that each of these companies are going to go to their bank and they are going to take out the type of debt they don't want. In other words, this could borrow swap line. So they are going to borrow what they don't want. Company A is going to go and borrow at 8%, and they're going to have to pay interest of 8% on that loan. Company B is going to go and borrow at LIBOR minus 1%, and they're going to pay interest on that. The next thing we need to take account of are the bank fees. And we've already seen the bank is going to charge a fee of 0.2% to each party. So that also needs to be factored into our cash flows. Now what we need to do is work out the terms of the swap. And there's various ways of doing this, but I think it's simplest if we think about what A is going to need to pay to B. Now the amount that A is going to pay B can actually be anything as long as it is linked to LIBOR, because remember we need a target outcome that has A with a LIBOR linked loan. But we can keep it simple by saying that A pays B LIBOR minus 1%, and that way it will match off very neatly with the amount of interest that B is paying to their bank. So if A pays B LIBOR minus 1%, B is going to be receiving LIBOR minus 1%. We now only have one step to work out. We have to work out what B pays A in order to make the swap work. Well, the amount that B pays A needs to leave us with our target outcome. And we know what our target outcome should be. It should be A paying LIBOR plus 0.7 and B paying 6.7% interest. Now the simplest way to work this out is to look at B. B is paying LIBOR minus 1% and is receiving LIBOR minus 1%. So those two net off. They're also paying 0.2% bank fees, and we want to have a target outcome that they are paying 6.7% in total. So how much do they need to pay to bring us to that target outcome of 6.7%? Well, they need to be paying 6.7% less the 0.2% they're already paying. So they need to be paying 6.5% interest to A. A is then receiving 6.5%. If you then add up A's column, you will see that they're going to be paying LIBOR plus 0.7% interest. Adding up those numbers brings us to our target outcome, LIBOR plus 0.7%. And of course, both of those amounts are amounts payable, so we'll put them in brackets. That's how the calculation works. It will get easier with practice. And once you're familiar with it, you'll find it's a pretty straightforward way of earning marks. Okay, now that we've worked through a full example, have a go yourself at lecture example 2, where again we've got some information about companies that are entering into a swap. Now be a little bit careful with this one, because in this example, it does not state that the benefits are going to be shared equally. In fact, what you're given in the text of the lecture example is the terms of the swap. So you are given the terms of the swap, and you need to calculate the benefit. You need to calculate how much each is going to benefit from the swap. And I'll give you a clue, they do not benefit equally in this particular swap. So estimate the gain or loss, suggest how we might change it, and also have a think about risks involved in the swap, just to recap some of the material we covered earlier on. Press pause, have a go at doing this yourself, and press play when you're ready to debrief. Okay, now for this calculation, it's still helpful to have our pro forma, because we need to work out how much better off each party is with doing the swap compared with not doing the swap. So, thinking about part A first, we have our two columns, Swain and Franco, and we need to be clear about what each of them wants. Swain is looking for floating rate finance, Franco, therefore, is looking for fixed rate finance. So, Swain is looking for floating, Franco is looking for fixed. Now, without the swap, Swain can simply go to their bank and they can borrow floating rate at 7%. LIBOR is currently 6%, so they're borrowing at LIBOR plus 1%. Franco can go to their bank, they can borrow at 12.75%. Okay, so that's if they just go to their banks and pay the interest on the loan that they're looking for. Now with the swap, they're going to be a bit better off. And because we're already told the terms of the swap, we don't need to work those out. We can actually go straight to what the cash flows will be if they do a swap. If they do a swap, Swain gets the type of debt that they don't want, so they go and get fixed rate borrowing of 10%. So they are going to borrow at 10%. They're going to pay interest at 10%. Franco will go and get the type of borrowing they don't want. They're going to get variable rate borrowing at LIBOR plus 3%. And they're going to pay interest on that. We're then told that in the swap, Swain will pay variable LIBOR plus 2%. So Swain pays Franco LIBOR plus 2%. Which means that Franco is receiving LIBOR plus 2%. Franco is going to pay Swain, we are told in our material, 11.25%. So Swain is receiving 11.25% from Franco, they receive 11.25%, Franco pays 11.25%. In addition to that, they're going to have to pay a fee. Again, we're given that in our material. The fee is going to be 0.2% to both parties. So we can take off 0.2% and 0.2%. That means we can add up these columns to get our outcome for each party. If we add up the column for Swain, we can see they end up paying LIBOR plus 0.95%. That is the total net interest that they will pay, taking all of those cash flows into account. Franco will end up paying 12.45%. So now we're in a position to work out what their gain is. We can compare the outcome after the swap with the amount of interest they would have been paying without the swap. So without the swap, Swain would be paying LIBOR plus 1%. With the swap, they're paying LIBOR plus 0.95%. So the gain is 0.05%. If we want to put that in monetary terms, we're told the amount of the debt. The debt is £100 million, so 0.05% of that is £50,000. That's how much better off they are. Franco, on the other hand, would have been paying 12.75%. They are paying 12.45%. That is a gain of 0.3%, or £300,000. So in this example, the gains are not actually being split equally. Now, part B of the question asks how we might amend the terms of the swap so that Swain receives a gain of 25 basis points, or 0.25%. Well, to do that, we'd obviously need to change the terms of the swap by 0.2% in favour of Swain. Now, there's multiple ways we can do this. The simplest way is to say, okay, Swain pays Franco less. Going to pay them LIBOR plus 1.8% instead of LIBOR plus 2%. Or Franco pays Swain 11.45%. So we can adjust the terms in multiple ways so that Swain receives a gain of 25 basis points. Would Franco agree to this? Maybe not if they didn't have to, but even if they do agree to this, they'll still be 0.1% better off than they would be without the swap. So if it was a deal breaker, maybe they would. And then finally, what are the risks involved in this swap? Well, the most obvious risk involved in this swap is counterparty risk. If, for example, Franco were to go bust, then the swap would unravel and Swain would be left with the type of debt they don't want. They would be left paying the 10% fixed rate that they're trying to get away from. Now, as I said before, the calculations involved in swaps can actually represent quite easy marks by the time you get to the exam. But please do bear in mind that things like describing the risks involved in interest rate swaps or the pros and cons are likely to carry just as many, if not more, marks than the calculations themselves. So it's vital that you understand what's going on as well as can do the numbers. One of the other tools that organisations can use to manage interest rate risks is a forward rate agreement. And what a forward rate agreement does is it fixes your interest rate at a future period. So if, for example, you were looking to take out a loan at some point in the future, and in the illustration here it's now the 1st of January, we want to take out a loan on the 1st of April, we want to protect ourselves against the risk that interest rates will rise before the 1st of April. We want to fix the interest we're going to pay on that debt. The forward rate agreement will allow us to do that. The terminology here is that a FRA that's referred to as 3/6 starts in 3 months and finishes in 6 months' time. So it starts in 3 months and then it lasts for another 3 months. Let's illustrate this briefly with some numbers, and I would stress you will not be asked to do these numbers in the exam, but the illustration might help you to understand how a forward rate agreement works. We've got a company that's going to need a £5 million 6-month fixed rate loan from 1st July. It's now 31st of March, and they can get a FRA at 6%. We'll illustrate what happens if, by the 1st of July, by the time they take out the loan, the base rate is either 9% or 5%. Well, if it's 9%, then Hazel is going to have to pay interest, and the amount of interest payable is going to be £5 million times 9%, and then because we're only dealing with a 6-month loan, and 9% is our annual rate of interest, remember interest rates always quoted annually unless you're told otherwise, so we're going to multiply that by 6 over 12 to represent the fact this is only 6 months worth of interest. That means they're going to pay interest of £225,000. But because the interest rate has risen above the rate of the FRA, the bank will make a payment to Hazel. Now, this may or may not be the same bank that they're borrowing from. But the bank is going to pay Hazel the difference between the FRA rate and the base rate. That is going to be 5 million times the difference between 9% and 6% times 6 over 12. So 3% times 5 million times 6 over 12 gives us £75,000. So they're going to pay interest of £225,000 on the loan, but they're going to receive £75,000 from the FRA. So that means the net interest that they're going to pay is going to be £150,000, which is equivalent to 6%. So we'll fix their interest rate at 6%. If, on the other hand, base rates have gone down to 5%, then again they're going to pay interest, and it's now going to be 5 million times 5% times 6 over 12. They're going to be paying interest of £125,000. Now, because the base rate has gone below the FRA rate, Hazel is actually going to make a payment to the bank. And the amount they're going to pay them will be 5 million times the difference between 6% and 5% times 6 over 12. So Hazel is going to pay the bank £25,000, as well as the interest they're paying on their loan. So how much are they going to end up paying? They're going to end up paying £150,000. In other words, they're still paying 6% interest. So it's always going to bring you back to the FRA rate, but the numbers just illustrate how this works. One of the other tools that organisations can use to manage interest rate risk is interest rate futures. We previously looked at what futures are in general, and now we'll look at specifically how they can apply to interest rates. Interest rate futures, by convention, are priced by subtracting the interest rate from 100. So it's easiest to see how this will work by looking at some numbers. Let's say I'm a borrower, and I'm borrowing money at 6%. Current interest rate is 6%. But I'm worried that interest rates are going to go up. What I'm going to do in that case is I'm going to sell interest rate futures. And the price of those futures, which remember is 100 minus the interest rate, is going to be 94. What then happens, let's say, is that interest rates go up to 10%. So I'll be paying more interest on my loan. However, what I can do now is I can close my position in the futures market. And I close my position by buying interest rate futures. Now, because interest rates have now gone to 10%, the price of the futures now is going to be 90. So what I've done, I have sold at 94 and I've bought at 90. In other words, I have made a gain equivalent to 4 points on the future, and that gain will offset the extra interest that I'm paying on my loan. Similarly, if interest rates went down, I would be paying less interest. However, I would make a loss on my futures transaction. If you're an investor, you won't sell futures, you'll buy futures. It's the same calculation, but in reverse. Now, just to stress again, these are not calculations you'll be required to do. They're just to illustrate what's going on. I'll also mention at this stage, it is possible that actually there will be a difference between the interest rates in the real world and the interest rate as reflected in the futures price. This may happen for various technical reasons. If that happens, then clearly futures are not going to be as effective a hedge against interest rates going up. The risk that that happens, the risk that the futures prices don't reflect the underlying rate, is called basis risk. The final tool we're going to deal with are interest rate options. And options are, as we've seen, the right but not the obligation to trade. And in this case, the right but not the obligation to trade interest rate futures. So a company can have an option to exercise the futures if it's in their interests. What this does is it sets, for a borrower, it sets a maximum interest payable. For a borrower, or a minimum receivable for an investor. In the same way as we saw previously, it set the maximum price we were going to pay for our cocoa beans. So an option works that way to limit our risk. Now, as with all other types of options, a premium will be payable if we want to use it. Now, lecture example 4 focuses on an area that's very examinable, main advantages and disadvantages of each of the instruments we've looked at. Based on what we've covered so far, have a think about what the pros and cons of using each of these will be, and then press play when you're ready to debrief. Okay, well, there are a number of things you could put down here, but we'll dwell on a couple of the pros and cons for each of these tools. One of the big advantages of forward rate agreements is that they provide certainty. They provide certainty about how much interest you're going to pay, and as such, they can help with planning. They are also flexible because they are over-the-counter, bespoke instruments. They can be for the amount and the duration that you want. Some of the disadvantages, well, it means that you can't benefit if interest rates fall. If interest rates fall, then you still pay the FRA rate. Another disadvantage of forward rate agreements is that they are not tradable, and that means that they're not as flexible as those instruments that are tradable. Once you've taken out the FRA, you are stuck with it. Now, interest rate futures, some of the advantages they have, they are fairly cheap. Provided you're dealing on a fairly large scale, they're not too expensive to deal in. They also benefit from having flexible timing. So you can decide when to close out your position, and in that way keep more control over your hedging strategy. Some of the disadvantages, well, like all other types of futures, you are dealing in standard contract sizes. So you can't tailor your contract, you can't tailor what you're buying to your exact needs. And as we saw, With futures, you do run basis risk. You run the risk that the price of the future may not accurately reflect the interest rates in the real world. And interest rate options, what's the advantage? Well, the main advantage is that you get to keep the upside while protecting yourself from the downside. Another advantage we could mention is that they can be bespoke. You can get over-the-counter options that are tailored to your exact needs. Some of the disadvantages, well, they are expensive. You have to pay a fairly large premium to get this protection. And secondly, they are often limited duration. Long-term options get very, very expensive indeed, so usually options are for quite a limited period of time. Finally, in this chapter, we're going to look at caps, floors and collars, which are some of the ways in which you can use interest rate options. An interest rate cap sets a maximum payable on your loan. So you guarantee, you buy an option, you buy a put option, and guarantee therefore that you won't pay more than a certain level of interest. However, you do have to pay a premium in order to do this. Interest rate floors, on the other hand, it says here, can be set with call options, and that sets a minimum amount of interest, usually receivable. So an investor might decide to buy an interest rate floor, so that, for example, the amount of interest they receive will not go below 3%, and thereby they can protect themselves from the risk that interest rates fall. Now, these can actually be combined to form an interest rate collar. Let's say that I'm a company that is borrowing and I'm worried about interest rates going up. So I go to my bank and I want to buy a cap, let's say at 9%. Now, the bank will do that for me, but there is a big problem. They will charge me a very large premium for that. So I'm going to have to pay a premium. And it's probably more than I can afford. However, what I might do is offer the bank to sell a floor. So I might sell a floor of, say, 3%. That means that if interest rates go below 3%, I will still pay the bank 3%. So the bank will benefit from that if interest rates go down. That means that I will have a receipt from my floor that I can use to reduce the cost of the premium. So it's not going to cost me as much as a simple cap would. Where that will leave me is with a collar. I will combine a cap and a floor to create a collar. In this example, the cap of 9% and a floor of 3%. What that means is, as long as interest rates fluctuate between these two rates, between 9% and 3%, I will pay whatever the interest rate is. However, if interest rates go over 9%, as it does A here on the diagram, I will still only pay 9% interest. If interest rates go below 3%, I will still pay interest of 3%. So the interest rates that I actually have to pay will move between these two boundaries, will move within the boundaries of the collar. Okay, let's recap the main points in this chapter. We started off by defining interest rate risk. And the type of interest rate risk you are going to see most commonly in the exam is a company that is borrowing and therefore has a risk to profits if interest rates go up. Do bear in mind, however, that this is reversed for investors. For investors, the risk is that interest rates go down and that hits their returns. We looked at three ways in which companies can manage this risk, three internal procedures, which were matching, smoothing and pooling. We then started to look at some of the external tools, and there are four, which are covered by your syllabus. Please remember, the one that is numerically examinable, therefore you need to know the numbers in a bit of detail, is swaps. So what interest rate swaps allow companies to do is to swap cash flows. Two reasons. Firstly, it is a quick and easy way of changing the nature of your borrowing from fixed to floating or floating to fixed, and it can also be a bit cheaper. It can also allow you to borrow more cheaply when there is an advantage doing the swap. And then we talked about FRAs, interest rate futures and interest rate options. You do need to understand how these work. And you can use options, if you like, to combine together to form a collar. If you combine a cap and a floor, you can form a collar which reduces the cost of your protection against the risk of interest rates rising.